We've got a few questions that we'll kick off with, and then we'll open up the floor. So, Dr. Wilson, I guess just in terms of everything we've talked about, if you think about specifically for investors, what do you think some of the key considerations are that investors should be thinking about right now?
Well, look, I'm always a believer that the best investment strategy clearly is to look for the medium and longer term. I think, and I think the economy really is pointing us in that direction anyway. I think that it's a little bit more about yield than capital growth. Capital growth is always important, of course, but I think that there's now more of a balancing in investor, I guess the investor hook, and it's about yield as much, not as much, but certainly yield is becoming more important in a low growth, low income economy. And look, we still have significant taxation advantages in terms of negative gearing. I'm not sure the ALP will go to that at the next election. We'll see, but they may, that is to change negative gearing, they may alter that slightly or not slightly. Also, we have capital gains tax discounts and the capacity of tax depreciation to depreciate the assets. So these are all positives and can work, into your particular investment portfolio. So I think look to the medium to longer term. Understand that there will be more demand for residential investment, as I have given you the reasons for tonight. And as I said, the waves of negativity in terms of trying to change residential investment, I think particularly given strong increases in rents, I'm not sure how APRA or the banks, and I think the banks are going to start lending to investors soon because they're going to realise that they will lose market share to other banks, smaller banks, because investors are because there's no real sign, because the risk aspects will be clearly moderating. But as I said, I think that with rents now rising very strongly, I think that there'll be a move, understanding that can have a significant impact, not just economic impact, but social impact, they're trying to offset or moderate investor activity. I think that those actions may change soon.
Yeah, so in terms of the banks and APRA for that matter, in terms of limiting borrowing to investors to try and cool this perceived property bubble driven by Sydney and Melbourne, what are your thoughts on that?
Well, I think that, as I said, once rents start to rise clearly, and I'm bemused by the Reserve Bank continuing to say that rents are growing at the slowest rate in 2 decades. Well, that's clearly not the case. It's not just our modelling; it's other modelling. The representative bodies, the state government departments are tracking very strong rents in Melbourne and Sydney, growth particularly, and also in Hobart, in Canberra. Rents are growing very strongly, and particularly in Hobart. Now, it's one thing to be concerned about first home buyers, and obviously we should be, but that's concerning about owning a home. But when you can't find a property to rent or to live in, or your choices are extremely limited in terms of where you live and what you pay for it, I think that becomes a very significant problem, and it will become a very significant political problem. I think that once that occurs, there'll be a shift in sentiment because restricting, in an undersupplied rental market, restricting investor activity is just, a recipe for disaster, I believe.
Mm-hmm. Absolutely. No, that's great. And if you think about interest rates, and you've talked about interest rates already, but any predictions on interest rates in the next short to medium term?
Okay, well, first of all, let's forget any official increase in interest rates. Now, as I said, I think we're looking again at another quarter of negative growth. Certainly, it'll be very close over the March quarter, and I'm not the only one saying that at the moment. This is not the environment to be raising interest rates. Even though our unemployment rate improved over April, down to 5.7%, we've still got terrible underemployment. Incomes growth, as I said, is lower than inflation. Retail sales are falling. Now, this is an economy that needs more stimulus, doesn't need stimulus to be papered. So the prospects of higher rates, and they've always been really nonsensical. It's been really a case of, well, they're low, they must go up. Well, they've got to have a reason. Higher and lower rates have to have a reason, and the case for lower rates is certainly strengthening, particularly given the bank tax and particularly given I believe the government will not be able to stop the banks from increasing interest rates to offset that tax, and the banks will clearly be able to point to the government as having taken the blame.
Okay, we've got a question here in terms of we've talked about your predictions for the market over the next 12 months, but there's a question here in terms of areas that you see as sound investment choices and conversely high risks, bearing in mind what you've already said around some of the key drivers in the short term, but also looking at from a long-term perspective.
Okay, well, look, I think given, as I believe, we'll see a surge in first-home buyer activity in the Melbourne market, I think the Melbourne market still offers some pretty good value, particularly in the northern suburbs, where we're seeing a lot of activity, actually, and also down in the southeastern suburbs. And as I said, Melbourne is very short of rental properties at the moment. There's strong competition for rents, for rental properties there, and that's unlikely to change. There's still a significant barriers to new supply in the Melbourne market. And even, the record levels of apartments, there's, as I said, some issues there, particularly foreign investors who are leaving them empty. Look, the new stock's being soaked up. We've come to the end of the supply cycle. So I think that Melbourne looks to be an undersupplied market, particularly given a surge in first home buyers likely in the second half of the year. I think that'll push those buyers will obviously push into the $400,000 to $500,000 range, maybe $600,000 range, and that'll create, I believe, some ripple effect through the market. So I think, value suburbs to the north of Melbourne, to the southeast of Melbourne, in that roundabout the $500,000 to $600,000 range, I think have got good upside for prices growth. I think yields will be maintained because of rental growth, and I think that's a bit of a standout at the moment. In terms of perhaps a shorter term market. Other markets appeal. I mean, the Hobart market's always appealing. It's had very strong prices growth over the last year. It's pushing towards a $400,000 median now. It's virtually run out of rental properties. Its prices are growing. Its rents are growing by double-figure rates a year. But and locals aren't terribly interested in investment properties down there for some reason, and it's also not on the radar for mainland investors either. But on the numbers, the Hobart market looks quite good, and migration is certainly turning around into Hobart again, that key driver, and the economy is starting to look a lot better as well. And of course, that's what migration does. For a longer term play, I've mentioned Brisbane a couple of times today. I still believe that, and I've got no vested interest in this, so I still believe that the inner suburban Brisbane market, in parts, offers remarkable value. I mean, the yields are over 5% in new inner suburban apartments in Brisbane. Now, that yield is notionally too high and is certainly a value representative. And the reason that the yield is high is because rents, which are very similar to Melbourne rents for apartments, are certainly higher in relation to the price of the units. I mean, there are units there. We've got median two-bedroom units in Brisbane, median price at about $350,000. So hence that high yield. So I think for a longer-term play, Brisbane apartments appeal as well. I think there's a lot of first-home buyers, particularly local first-home buyers, looking at that market. And given the fact that there's virtually been a collapse in new approvals or building approvals for apartments in Brisbane, I think that it means that when the current stock is soaked up, there won't be a lot coming through. And of course, that's the nature of those inner city high-rise markets, the zoning, the capacity to get appropriate zoned land, even if there is demand, it becomes quite problematic. And you've got to remember that the Gold Coast is hosting very, very strong market, the Gold Coast at the moment, and it's hosting the Commonwealth Games next year, and that'll be even more of a surge into that Brisbane market. So I think that appeals as a good prospect. I think those Brisbane apartments, and I think at around $350 for a two-bedder and a 5% return, and still not too tough to find a tenant. I think that's a little bit of a standout over the medium term.
Great. Okay. Yeah. So there were a couple of questions. We had a question from Dominic about Southeast Queensland and whether that included Gold Coast as well, and which you've touched on, and also from Stephen saying, would you lump Gold Coast and Sunshine Coast in with your broader Brisbane predictions?
Yeah. Well, Well, we can talk about both those markets, Clint. Certainly the Gold Coast is Queensland's strongest regional market at the moment. I think the Gold Coast will surprise me if it doesn't grow by 10% this year. There's a number of reasons for that. There's been a lot of jobs growth there, of course. It's sort of back in town, the Gold Coast. Apartment yields are very high, so that appeals to investors. There's a shortage of rental accommodation there. But the other point that's driving the Gold Coast is the very, very strong markets in northern New South Wales. Byron Bay, Ballina, Lismore, Tweed Heads are very, very strong markets. In fact, those markets are the strongest regional markets in the country at the moment, but very, very high prices. And, the Byron Bay median is just touching up towards $1 million now. And it makes it remarkable value. I think a lot of retirees, a lot of investors are now heading over the Tweed, looking at the southern part of the Gold Coast and central Gold Coast for value, particularly in apartments. But that's a very strong market in Prospect Gold Coast. It's been the strongest market, up by 7% last year in Queensland for the last couple of years. But I think that'll only grow for those reasons: the Commonwealth Games, strong northern New South Wales development. The Sunshine Coast, look, the Sunshine Coast, Brisbane, Gold Coast tend to move as a bit of a monolith, if you know what I mean. But the Gold Coast is certainly pulled away from the Sunshine Coast in Brisbane in terms of growth. But I'd expect steady growth in both those markets, but not in positive growth, the Sunshine Coast. But, we're probably talking 5% for both those markets this year, as I said in the graphic, whereas we're talking closer to 10% for the Gold Coast.
Great. Excellent. Now, Simon has asked for some more thoughts about the high number of properties in Melbourne that are empty with no tenants, and the impact it could create in terms of supply.
Yep. Well, look, this has been. I mean, I said this, 18 months ago that, particularly Chinese investors are not. A lot of Chinese investors are not that interested in getting a tenant. They're not that interested in getting a buyer. You've got to understand a lot of the attraction to Melbourne from Chinese investors is cultural, not just financial. We have a very strong Chinese community in Melbourne, one of the strongest in the world. And, there's a sense of international Chinese investors wanting to have a foothold in what they regard as, a free and open and prosperous, and financially secure economy, and with those cultural connections. And I think that's part of the reason why so much of, particularly the Hodl block, the CBD market, hasn't really added to supply. And this is obviously something the local government there has recognised. There's now going to be a process of identifying empty properties, and they will be taxed. And the federal government's also moved in on that one, and there's a $5,000 levy now for if you leave property empty. I think it's 6 months you've got. I think that's quite a remarkable policy, because I have no idea how they're going to police that. I think that's almost impossible to police. And I think to a large degree, a lot of international investors will just pay the levy and accept it as the cost of doing business. I don't think it's going to make any difference to what is that undersupply of property in the Melbourne market. And as I said, it's been a bit of fake property news, really, this undersupply thing in Melbourne particularly, and Sydney, of course. Sydney is just completely undersupplied at the moment, and will continue to be so, really, for the outlook. But obviously it's a very high price market to get into, and yields because of that are lower. But I think that, and Melbourne has significant roadblocks still to unit development outside the CBD market. Although we are seeing more development in some of the middle ring suburbs, it's still not enough to keep up with demand. And one of the problems is that you've got growing downsizer demand, and there's nowhere really affordable or acceptable for downsizers to go to. I think they'll start heading into, as I said, 2 or 3 bedroom apartments, and I think we'll start finding an appetite for, even Docklands and Outbank larger apartments from those downsizers, that have basically ignored those markets because of the incentives now to downsize, and a lack of options in terms of downsizing. So look, forget the Melbourne oversupply. So we've got Melbourne apartments growing by around about 2% per quarter at the moment.
Great. All right. I'm looking forward to your answer to this question. So
Yep.
Jason has asked, why can't the government bring out state-based policies to subdue states like New South Wales and promote activity in states like WA?
Well, because the states wouldn't let them. Look, and I think that this is the conundrum, that we have a one-size-fits-all policy mechanism for monetary policy. And, for fiscal policy, we have the GST. So that means that we can distribute taxes according to particular state needs, right? So we can sort of mix that around a bit. But in terms of monetary policy, the cost of monetary policy, we only have the Reserve Bank. And this is what the conundrum is at the moment. And the conundrum is, A, there are underperforming markets, and B, there are perceived overperforming markets. Well, I don't believe there are any overperforming markets. I just think it's local factors. And, we never reach fifth gear, if you know what I mean. We never get into overdrive in our housing markets. There's always that moderation, and that's what the banks do for us. But, look, it's a conundrum. And I think that one of the issues that we need to address, not just monetary policy, which is difficult, of course, is to, and this is probably what the question is alluding to as well, is that we've got to start maybe taking the planning capacity away from local governments, if you know what I mean. I think that one of the biggest issues we have is the roadblocks to orderly planning that meets demand. And I'm not suggesting, a willy-nilly, let's build anything anywhere type of policy, but I think that we need to maybe have more of a authority from, move away from sort of local political dynamics, that could even be state dynamics, into more of a national role. And I think, governments could actually think about buying into that sort of a national view of land planning, you know what I mean? I think that would do a lot to take away the local issues and a lot of the local nonsense that goes on, and try to think of the bigger picture without, as I said, having unfettered development, which I'm not advocating.
Sure. So we've talked a bit about the capital city markets. Ivan has asked, what is your take on regional property market?
Well, look, regional markets typically follow the energy from the capital city market, which sort of makes sense, doesn't it? Now, there's no doubt in New South Wales, it's almost, a sort of a firestorm north and south of Sydney on the coast. Very strong market activity, as I said, all the way up to the Northern Rivers, Tweed, very, very, very strong, Coffs Harbour. All those areas have been quite strong. Newcastle is booming, so is Wollongong. But interestingly enough, as you move closer or westwards, markets haven't got that same sort of energy in New South Wales. Talking about Orange, Wagga Wagga, Dubbo's okay, but they really haven't taken off as some of those coastal markets have. So that's sort of quite interesting. I think that's, obviously an option for those buyers, priced out of the Sydney Basin, is those regional markets. And I believe governments should take some sort of action to encourage people through flexi-time arrangements or telecommuting to move into those more affordable areas. And New South Wales certainly has a lot of them. But and the Queensland regional markets, of course, southern Queensland, as we've discussed, southeast Queensland's doing quite nicely. But once you move north of Bundaberg, it is tough because of the shakeout in the resources sector. But I did a road trip up there at the end of last year, and there are certainly early signs now that those markets too are bottoming out. Gladstone, Mackay, Rockhampton, Bundaberg, all starting to look like they're reaching the bottom of their cycle. And their medians are around about $300,000. And I've got a bit of a theory that, in the current cyclical conditions anyway, that $300,000 in a regional market is just about where you start to grow again. And that's what's happening in those markets. Cairns has been a reasonable performer through the shakeout in regional Queensland, north of the Sunshine Coast. But the market that clearly had no significant issues, other than obviously some of those Gladstone areas, has been Townsville. And Townsville's continuing to struggle economically. A number of policy issues there didn't do that market any favours. NRAS, defence housing issues there that was really crowded out the local rental market, and it's struggling with its economy. It was the biggest regional economy in the country. Still is, but it's certainly struggling for a number of reasons. But I think there's a light at the end of the tunnel for most Queensland regional markets, north, as I said, north of Sunshine Coast. In Melbourne, it's basically Bendigo and Ballarat. They're sort of the twin forces in terms of they usually track each other. We saw Ballarat clearly move ahead of Bendigo over the last couple of years, but Ballarat's sort of flattened out a little bit recently, and Bendigo's taken off. So it's sort of re-establishing that longer-term relationship. I think Ballarat is likely primed to be a strong performer over the medium term because it's still basic. Well, I think eventually it'll become part of Greater Melbourne if it's not already, because it's only an hour's commute on a good drive into the western suburbs of Melbourne. Plenty of work opportunities there, and western suburb property is growing quite strongly now in Melbourne. So I think Ballarat, those looking for a bit of a mixed lifestyle as well as a commute into Melbourne, appeals. But it has been quite soft, that market, recently. I'd expect it to start picking up. And regional markets really, the Geelong market's very strong at the moment. Of course, again, that tends to be a bit of a quasi-suburban market of Melbourne, but that's been quite strong recently as well. Again, similar to what the Wollongong and Newcastle experience is in New South Wales, close to the major capital, of course. But the regional markets elsewhere, they really aren't significant in Adelaide or in Western Australia. They're mainly about the capital city markets.
Mm-hmm. Great. So swinging back to Sydney, Sandeep has asked some suggestions on good suburbs for first home buyers in the Sydney market.
Well, I don't think there are any. It depends what your money is, of course. I mean, everywhere in Sydney is a good place to buy. It's just a question of how much you have to spend. So obviously you look for value, and the value can be, I guess there's a measure of, how many dollars per kilometre from the CBD sort of thing. But look, I think there's some good opportunities. Still, just been a flat point in Canterbury Bankstown recently. That's a market that's just shifted sideways after some strongish price growth. I still think there's some good opportunities in some of the suburbs in Canterbury Bankstown. It's the old story, the border of Canterbury Bankstown. Once you get to Parramatta, you get the price shift, but it's a question of how far out you want to go to pay less. And depending what your budget is, you try to get closer in. But the Sydney market is a very strong market. It will remain a very strong market. It's an undersupplied market. It's geographically challenged. It can't continue to spread. More and more people are deciding to live in apartments. But even the apartment threshold for a first home buyer close into the CBD is at least $750,000 for a one bedder, and that's a very big spend for a first home buyer. And even out on the fringe, I think we've only got 3 suburbs in Sydney now that have a median house price under $500,000, and that's Macquarie Fields, Wilmot, out in the far western suburbs. It's a lot of demand. And really clearly an undersupplied market, and it will remain as such. It's very much, and I say this, and it's probably a bit trite, very much the New York of the Southern Hemisphere. It's just sort of got that very high price tag now, and which is great if you're a property owner or an investor in that market. And it has the attractions, tourist attractions, the strongest economy in the country. It will always continue to grow at around the fastest rate through the longer term of any of the capital city markets, and basically as an undersupplied market. And as I said, we're now starting to see a move from downsizes into apartments as well. So if you're a first home buyer, it's a question of how much you've got to spend, but it's always difficult to find something. I guess it depends on, as I said, your choices, what you're looking for. But even in an apartment, you're going to sort of struggle to get something around $400,000 or $500,000 in Sydney.
And Narendra's just added price impact in Western Sydney from the announcement of the second airport.
I think that gives a little bit of hope to Sydney in a sense, because I think that the second airport is a very positive move, and I think if anything, it's going to push prices up, because what will happen is, look, it might take a bit of pressure off the Sydney areas, such as Canterbury, Bankstown, Parramatta, because or out Parramatta, because you're going to get a lot of infill development up through the southwest, because Badgerys Creek will likely be a budget airline. There'll be a lot of freight in and out of Badgerys Creek. I think you'll get a lot of commercial industrial development close in to the airport, which of course creates jobs, and a lot of logistics opportunities, a lot of economic growth there, which I think will mean that the plan is to get Parramatta as the second CBD, which means people will start moving towards Parramatta rather than Sydney. But I think given strong job opportunities and a development in that in that area out to Badgerys Creek will mean in those areas a strong prices growth. We're already seeing quite strong price growth out in that region anyway. Oran Park, median house price over $750,000 now. It's just, as I said, another sign of clearly an undersupplied market, even on the fringe in some of these newer areas. So I think it's a positive for the economy, take some pressure off, demand closer into city-centric, I guess, demand that's inside Parramatta. But I think at the end of the day, there's just far too many people and not enough houses in Sydney, and that's likely to remain the case for a long time.
Absolutely. Now, I know the answer to this question already, but Luke has asked, can I ask where Dr. Wilson is buying his next investment property?
Well, now what would you think of me if I told you where I bought my next investment property? You'd think, wow, he's going to tell me something that is going to promote that particular area. Now, look, I'm not involved as you guys are in the investment field. I validate myself as being as objective as I possibly can. I think that's why sort of listen to me. Hopefully, that they know I don't have any vested interest anywhere in anything, and that's how it's going to remain. I've been in property all my life, and even going back beyond my life, my background, my parents, my grandparents were all in property, and as I said, my passion is property, but my passion is analytics, not investment. So others who do that, such as yourself, Clint, which is horses for courses.
Absolutely. Very good. Yeah, I did laugh when I saw that question come up. Now, Bill has asked, you mentioned you recently talked in WA. What was your prognosis?
Well, I did a presentation for some developers yesterday. I was down in Melbourne, but they're doing some work across in Perth. So they're interested in my call on the Perth market. Now, as I said, we know that Perth markets struggled because of the shakeout in the economy. No surprise. Perth was really a victim of its own success. The fly-in, fly-outs was something highly unique in terms of an economic driver, of course, into Perth. We all, had stories about you could go and work for 6 weeks in the northwest and earn, a lot of money, and people did that for years, really, to make that sort of money. But when the work ran out and the mines were completed, that was the end of that. But what it was an artificial demand for accommodation. And that, of course, finished, and that meant that, there was a hangover after that big party, and that's what that market's gone through. But as I said at the beginning, I thought it was interesting. I ran the latest data, and it's clearly showing that the Perth cycle is clearly looking like bottoming out now. I'm not going to say it has bottomed, but there's no doubt that the underlying trend is flattening in terms of its cycle, and it's well above. It sort of made me feel pretty positive because it was above my model. So it sort of validates that model scenario. And I think that, as I said, the price, it's what happens is you're moving into a period which is, and we've seen it in other markets recently as well, when prices sort of reach a critical point. And as I said, it's what's happening in central Queensland at the moment as well, regional Queensland, central and north. And that's the value perceptions. You see, people start to say, well, prices are at 3 or 4 year lows, and it almost becomes irresistible to become a trade-up buyer in that market, because you can obviously improve, I guess, yourself in terms of your property size, its location, its fittings and fixtures. And with low interest rates, it means, yes, even if you find it tough to find a buyer and you maybe have to discount your property, it's actually a bit of a win-win if you can get a discounted price on a higher property. So what this happens is it starts the ball rolling in terms of those value perceptions, and that's a recovery of confidence, slowly, incrementally, but it's happening. And I think that's what we're starting to see the first signs of in Perth. Now, the other very interesting thing, which is probably more than just, I guess, a feeling, although the trend is clearly flattening, is the rental market. Now, vacancy rates in Perth fell below 4% for the first time in 18 months. There's no doubt that the vacancy rates trend is clearly declining. I always believe the rental market is a very good early indicator of what's happening in housing markets, particularly in recovery phases. And we're also seeing rents stabilising. Now, Perth rents were looking at one stage on trend to fall below those of Hobart's. In other words, they would have been the lowest rents anywhere of any capital city. But they've now started to stabilise, and they've been steady for the last 3 months. So I guess given, that correlates with vacancy rates falling, we're certainly seeing some early signs that the rental market is also balancing out, but more significant signs in that rental market than the price market. Definitely a clear downward dip in vacancy rates, definitely a consolidation, a stabilisation in rents, in rentals. So I think that's a good early sign. The rents are still low, obviously at near 8-year lows. Vacancy rates are still obviously high at 3.9%, but it's all about the trend. And I think that trend is about recovering confidence. And I think gradually you'll see, particularly if we get some lower rates, some more nibbles back into that from investors back into that Perth market. Clearly the trend, there's very good value there, but clearly the challenge is to find a tenant in that market. But I think owner-occupiers will become more active this year in the Perth market, given those value perceptions. But no doubt we're starting to see a little bit of a glint of light at the end of the horizon there, on the end of the tunnel.
Great. All right. I've got a few asking about specific areas. I'm going to throw a few at you. Ho's asking about Alice Springs. I've also got Linda asking about Darwin and your thoughts on that, and Aaron asking about the Sunshine Coast, especially Sippy Downs, and if you've got your crystal ball, whether he's going to get any growth this year, especially taking into consideration the large amount of infrastructure. So there's 3 for you.
Well, look, Alice Springs is a small market, Clint, of course, and movements in that market depend on, particularly government spending. Of course, there's a lot of Indigenous spending and government departments in those areas. Tends to be a very small market, so it's always tough to put a prediction on how that market's going. So probably a little bit too small. I haven't got my database in front of me here, otherwise I could give you the latest stuff on it. But if we've got any sort of a communication process, I'm happy to provide this information, through you, Clint, if you'd like to do it that way later on, or whatever. But certainly, as I said, Alice Springs is a smallish market and very dependent on particularly government spending and tourism. But as far as what was the other one, Sunshine Coast? There was one before that.
Darwin.
Well, look, Darwin's an interesting market. Again, a small market. The positives of Darwin's gone through the resource shakeout that Perth and Central Queensland went through. It lost a couple of large, or the end of the very large offshore resource developments there meant a lot of the management groups moved out of Darwin itself. Now, Darwin is still a very strong economy. It still has quite strong wages, high wages. It has lost a lot of demand, but I think the Darwin market prices were inflated by a lot of management demand of mining companies coming in and taking up a lot of the properties. I think now that demand's moved away, that the Darwin market's moved back to more of a rational house price outcome. And there's no doubt that Darwin house prices have flattened and are starting to grow again. That strong economy is helping the Darwin house prices. So it's certainly now stabilising in terms of that correction phase. However, the apartment market certainly has some way to go, I think. But there were early signs. And the other point is that vacancy rates for Darwin houses have fallen quite sharply as well. They're now well under 3 and heading towards 2%. So again, an economic revival there is helping demand for rental houses. But look, there's been a big building boom in Darwin, massive development of units. I go up there every now and again, and it's a great spot. But they certainly have invested heavily in city apartments, as you probably know, Clint. And I think there's a little bit of way to go there before that market flattens out. But certainly houses are looking quite positive in Darwin.
Great.
And Sunshine Coast, Sippy Downs. So Sunshine Coast is my old stamping ground. Not sure we can get that specific about Sippy Downs, but look, Sunshine Coast tends to be it's an interesting market that moves a little under the radar. It's sort of holiday makers, retirees at the northern end of the market. The middle part of the market tends to be more locals, infrastructure driven, as Sippy Downs would be, and the bottom end of the market, the Caloundra, etc., is retirees, particularly, although there's a lot of new estates going in the Caloundra area, which are being pitched towards first home buyers. So, look, a very solid market all the way through. As I said, I think overall the underlying growth in the Sunshine Coast is around about 5 or 6%. I'm pretty positive that will continue. It has a different sort of traction, the Sunshine Coast versus the Gold Coast. It tends to be more Brisbaneites looking for second properties, Melburnians particularly like the northern part of the coast, and retirees from Brisbane and Melbourne like the southern part of the coast. And I think it's a very steady market, and it certainly has appeal, and I would expect prices to continue to grow. But as I said before, Clint, I don't think we're looking at a Gold Coast result there. I think around about 5% this year, which is another good steady result for the Sunshine Coast. And I think that would be across the board in most regions of the Sunshine Coast.
Yeah, great. Okay, so switching tack a bit, Liz has asked, do you think that traditional methods apply considering the high level of household debt? So I'm just trying to recall what that related to, sorry.
Well, I can address that for a point. I mean, look, this is part of the sort of the black part of the black and white argument that we have in terms of the negativity for our economy and our housing markets. Now, this is a nonsensical argument. Now, all you do is you look at the growth in mortgages, and obviously that there's been a growth in mortgages because of lower interest rates. So the higher debt is because people could borrow more because interest rates fell. And yet, if we look, as I said, with the Australians have actually been quite conservative in their borrowing. They've even borrowed less than the banks have allowed them to borrow. And as I said, the banks act as that control force anyway. They're very conservative. But as I said, so we've had debt increase because people have borrowed more because they could borrow more. But the proportion that they're repaying in terms of their income is actually below average over the last 20 years in most capital cities. Now, so having said that, yes, debt is higher, but of course asset values are higher. And that's the point. If you track, the level of growth in lending, it tracks the growth in prices, and that tracks the change in interest rates. So it's all about a balance sheet. It's not just one side of the argument, which is debt. It's also about assets, and assets are higher than debt in a relative sense. Now, of course, the reverse happens when you have to pay higher interest rates. And there's no doubt that higher interest rates, as they always do, put downward pressure on prices. But again, as I said, we have orderly growth and correction phases. But at the end of the day, we don't have the prospect for higher interest rates to the point where we would see a significant shakeout in house prices impacting on those debt levels, because the debt would have to be serviced by higher interest rates, if you know what I mean. And this is just the nature. Of course, debt rises as interest rates fall because prices rise and people borrow more, pay for those higher prices. But at the end of the day, they're not allowed to borrow more than 80-20. And that 20% equity that they have to put in covers the banks for their risk.
Absolutely. So talking about interest rates, Narendra's asked, what time frame do you expect before the RBA will decrease rates?
Look, I don't want to sort of put my neck out here, but then again, I do. But I think that if we get negative growth announced at the beginning of June for the March quarter, I think that'll be a very sobering result for the Reserve Bank, because it'll be the second negative quarter of growth that we've had in 3 quarters, and that's not good. Now, I don't think that they could spin that like, oh, we're wishing and hoping and praying that things will get better sort of thing, because they have been very optimistic. Now, the other point is that we're getting more narrative about weaker prices growth, particularly in Sydney. Now, prices are still growing in Sydney, but we're certainly starting to track prices growth on a quarterly basis at under 2% now in Sydney. which is still, quite reasonable. But, it's not, the big levels that we saw at the end of last year where it was pushing 4%. So I think that those sort of factors will perhaps make the Reserve Bank a bit more circumspect. I think also they have to recognise, even if I have to ring them up myself, that rents are rising steeply in Melbourne and Sydney, and that by restricting investor activity, and that means higher interest rates from the banks, they're only going to create a lot of problems in these markets and a lot of very unhappy people, and that'll mean eventually a lot of very unhappy politicians too. So I'm sort of thinking now, but certainly I think the next move is down. It's certainly not up, and if it was up, it wouldn't be, in my opinion, for years unless we had a currency crisis. But as I said, I think that we may even be looking at a cut in July.
And if you follow on from that, an RBA cut in July, what will that mean for the banks? Because as John's sort of made the comment here, banks are acting very differently to the Reserve Bank in terms of
that's right,
interest rate
and that's what we saw. That's what we saw in the chart, wasn't it? We could see that out of cycle, a solid line on the red line, and that definitely had an impact. And that's the point. That's got to be another factor in the Reserve Bank. Now we've got reduced retail spending, we've got no incomes growth, we've got underemployment, and then the banks start raising interest rates. Now this isn't just going to be an investor interest rate activity. If they'll increase them across the board, and that's going to have a negative effect on the economy. So that's another factor the Reserve Bank will have to take into consideration. I think the Reserve Bank's in a corner here. They've been, and I think they're just praying to see some relief in terms of housing market growth. But as I said, I'm very bullish on Melbourne this year. It'll be interesting to see how that turns out. Given the history of getting rid of stamp duty for first home buyers, and usually there's a sort of a herd mentality from first home buyers, sort of the fear of missing out. They rush into the market quickly. And Melbourne's got a lot of affordable first home buyer type markets. That not having to pay typically the $10,000 in stamp duty means that they can release that into a deposit, which means that they could probably borrow another $90,000 or $100,000 and be able to repay it, because the repayments aren't really a problem, it's saving the deposit. So that sort of segues into a $500,000 purchase, which means that they can start looking at other areas. And I'm just thinking that, if we do release, and this is the government's plan, they want to be able to say, yes, we've found an extra 20,000 first home buyers. And if that's the case, given we don't have any extra supply, which we don't, first law of economics, of course, is higher demand and fixed supply is higher prices. So you will see as that $10,000 transferred into $90,000 extra buying capacity, which will just feed its way through the food chain. As I said, perhaps end up with $1 million median in the Melbourne house price next year. So what I'm trying to say is that this is another issue that may confound the Reserve Bank. It won't be all about Sydney. It'll be all about Melbourne's house prices. But look, hopefully that'll be later in the year before that becomes evident that there's strong growth happening there. And as I said, we've also got very strong migration in Melbourne as well. As I said, I think that the Reserve Bank it has this issue now that I think they'll be hoping that they'll have some signs that the Sydney market particularly is easing, and that they'll move on the economy. I think they're pretty happy with that 5.7% interest rate today, unemployment rate today. But I don't think they'll be kidding themselves that it's any great, any great sign of a great turnaround in our economy. We've got a lot of hard yards to do. And look, if the unemployment rate continues to improve, we get some better data, retail sales, but the trend is clearly poor there. As I said, I think the killer here is if we get a negative quarter of growth over March, the March quarter, I think they'll have to act. And if they don't, it'll be because they've blamed the cyclone for it.
Excellent. I've got a fairly theoretical question here from Hatham. He said, "What is your opinion on the theory that house prices will infinitely increase proportionate to the history of Australian house prices, despite the increasing disparity between house price growth and wage growth?"
Well, the wages growth has really nothing to do with house price growth. That's the whole thing today, is that what we show is it's all about interest rates, right? It's interest rate changes that determine the growth or the changes in house prices, notwithstanding local supply and demand factors which generate the level of growth, the rate of growth. And we should never look backwards to look forwards. I mean, that's the first trap some economists make, is to keep looking in the rear vision mirror. I mean, that's what we've done, and that's the mistake we've made with monetary policy. I mean, the theory was that to reinflate an economy, you up interest rates. But the point is, once you get to a certain point, they don't do any good. In fact, they become a negative. And certainly when they're at zero, it means you do enter into the quicksand of a deflationary economy. Now, Japan's been in deflation for 20 years. It's very difficult to reinflate an economy with zero interest rates if it's still going backwards or still not performing. So the point is that interest rates are the key here. And what's gone before us in terms of what's driven interest rates have been different economic circumstances. I mean, we had governments fixing interest rates until 1990, and then Keating government made the Reserve Bank independent. And, so before that, it was a completely different, environment for interest rate setting. But, we are in for, a very long period of flat interest rate growth. So therefore, that means low incomes growth, of course, because that's what low interest rates will mean if we don't have enough incomes growth, which means that that'll work its way into, flattening prices growth. So at the end of the day, that relationship will hold, but we can't sort of have the prospect of the roller coaster ride of, boom and busts that we've had in our previous resource-driven cycles, which really go back, to the 1920s in this country.
I've got an interesting. I've got an interesting. Yeah, I've got an interesting question for you here. It's almost like the old baby bonus. Steve has said there should be a policy where you receive a stamp duty discount if you're buying a house or a unit based on the number of children that you have. So if you've got 2 kids, 2 investment properties, discount, 3 kids, 3 investments. This will then enable the children to have a chance of inheriting and occupying these homes. Your thoughts, please.
Well, look, we can think of a number of very interesting and clever solutions on the demand side of the equation, correct? But there is the best solution for access into any market is to increase supply, all right? Higher supply with fixed demand means lower prices, just like the reverse does. Now, changes, creating differential policies, on the demand side, in a market which has very low supply response and getting lower supply response, will only cause imbalances at some level over the medium to long term. I think that the changes to stamp duty that the state government in Melbourne have announced will be great. They'll release hopefully thousands of first home buyers, great. But as I said, that will release the price energy that will push up prices. Now, those sort of prenatal first home buyers in Melbourne at the moment, in 4 or 5 years' time, maybe 3 years' time, will actually have to pay higher prices than they would have if they hadn't cut the stamp duty. And the higher prices will be based on that $10,000 extra deposit that the first home buyers are going to use to get into the market this year, right? You understand what I'm saying? But it's a political decision here that the government will be able to point to, that they've created all these extra first home buyers, and that's fine. And homeowners aren't going to complain if their property prices have increased. And even the costs of not collecting stamp duty from first home buyers will probably be offset by higher stamp duty collections from owner occupiers as prices rise. But I think that, all things being equal in the economy, and I don't usually say that, but if all things are equal in the economy going forward, we'll get back to the same proportion of first home buyers in 3 or 4 years' time that we've got now.
Absolutely, excellent. I've got
more supply. That's what we need.
Yeah, absolutely. Here's a funny one. Pamela has asked, do you coach people?
Coach them?
Yeah.
Too busy, mate.
Yeah. Absolutely. But Pamela, we don't
offer.
Pamela, we obviously Real Estate Investor, we don't coach people, but we do obviously compile lots of information and resources to help you along the journey.
Yeah, absolutely.
So jump onto
as I said,
our site.
Yeah, as I said, Clint, I think that horses for courses. That's what you guys do, and I'm an economist, and I comment on the market and the bigger picture. And I think coaching for investors comes from those that are absolute specialists in the field, and there's no doubt that InvestStar are.
Excellent, thank you. And actually, Eddie's asked, will this webinar be recorded for later viewing? And Andrew, you mentioned in terms of any other questions and feedback. So yes, we have been recording this webinar. It'll be posted on the Real Estate Investor website in the blog area. All of the slides that you saw will be there in a slide viewing area. The recording will be in two parts. There'll be the first hour, which was the presentation, and the second hour, which has been this Q&A. So everyone can go along and rewatch that there. And you also have the opportunity to post any questions or any comments in there as well. Ajit just said he can't see in the blog area any previous webinars, so they're definitely there, Ajit, and we process it, and this will be posted probably by around early afternoon tomorrow. So Andrew, I think what we might do is we're just coming up on 2 hours, so we might look to wrap up there. So if anybody does have any other questions, as I mentioned, feel free to type them in now or drop them into onto the blog post area of our site, and we'll make sure that they will get answered. But thank you very much, Andrew, for all of
thanks. It's been great.
Insights tonight.
Thank you for everybody for attending. I really enjoy doing these. It's great to be part of this. I guess a broader connection. I do a lot of presentations, and I enjoy it because it's a two-way process, of course. And I think we've just got to remain positive and try to remember that we've got a remarkably robust, as I said, resilient housing market, and the future will be even more about property, I think, given the nature of our economics. And I think people just have to be just a little bit more optimistic than our policymakers tend to be at the moment.
Look, I absolutely agree. And if you look at the country, and you look at population growth, and you look at supply,
yes,
as you said, if you take a medium to long term view, there's going to be a lot more people that are going to need houses to live in, and I think we as a country expect that people are always going to be able to live in a house, and the government aren't going to provide it, so it's going to fall to investors, which is why there needs to be ongoing concessions and benefits for investors to
absolutely
stimulate that. So
they provide all the stock, at the end of the day, and as I said, particularly that Sydney market, I think will eventually. I think Sydney, within a couple of decades, there'll be more investor properties than owner occupied.
Excellent. Well, thank you very much, Dr. Wilson, and
thank you. My pleasure.
Thanks to Terry Shear for arranging tonight as well, of course. And as I mentioned, if you have existing properties without landlord insurance, jump along to the Terry Shear website. You can see on the screen there. And as you're buying new properties, make sure that you get your landlord's insurance set up as well. So thanks very much, everybody, and we will say good night, and we'll look forward to seeing you at another Real Estate Investor webinar soon, and we'll look forward to Dr. Wilson's updates in the coming months as well. So thanks very much, everybody, and have a great night.